Most people think hitting $20,000 in savings is just a number. It is not. It is a line, and the moment you cross it, the entire game of building wealth changes. Not a little, completely. The strategies that got you here, some of them will actually hurt you beyond this point. The mindset that felt smart, it needs to be upgraded. And the opportunities waiting on the other side, most people never even see them because they never stop to understand what $20,000 actually means. Today, we are going to fix that. We are going to break down the $20,000 rule, what it is, why it exists, and exactly how you use it to accelerate everything from here. I am Ron Invest. If you are serious about building real financial freedom, hit that like button right now and make sure you subscribe so you never miss a video. Let us get into it. Let us start with the most important question. Why $20,000? Why not $10,000? Why not $50,000? What is so special about this specific number? The answer comes down to what $20,000 actually represents in your financial life. Below $20,000, your money is mostly in survival mode. It is covering your emergency fund, it is keeping you out of debt crises, and it is giving you just enough cushion to breathe. That is important. That is necessary. But it is not wealth. It is stability. The moment you push past $20,000, something shifts. Your money stops just protecting you, and it starts working for you. The threshold is real, and it has been confirmed by financial researchers, behavioral economists, and real-world investor data over and over again. $20,000 is where the compounding effect starts to become visible in a way that actually motivates continued investing behavior. Below it, growth feels invisible. Above it, growth starts to feel real. So, what exactly changes? Let us walk through it. Most people on their way to $20,000 have their entire net worth locked inside a high-yield savings account or a simple checking account. That is smart at first. You need liquidity. You need safety. But once you cross $20,000, continuing to keep every single dollar in cash is costing you money. Inflation is eating it. Opportunity is passing by it. The rule here is simple. Once you hit $20,000, you should be fully funded on your emergency reserve. Typically, 3 to 6 months of expenses, and the rest needs to be allocated. It needs to be deployed. Sitting on cash beyond your emergency fund is not safety at this level. It is a slow loss. A lot of people do not realize how many financial products have minimum investment thresholds. Certain index funds have minimums of $3,000 or more. Some brokerage accounts offer premium features starting at $10,000 or $25,000 in assets. Real estate investment vehicles, certain bond ladders, treasury direct strategies, they all become more accessible and more efficient when you have $20,000 or more working behind you. You are not just investing more money at this stage. You are investing better money in better vehicles with better terms. The universe of options expands, and that expansion is not small. This is one of the most misunderstood parts of crossing the $20,000 mark. A lot of people, once they finally reach this milestone, become extremely risk-averse. They worked so hard to get here. They are terrified of losing it. And so they do the one thing that quietly kills their long-term results. They stop taking calculated risks with their money. Here is the truth. At $5,000, being ultra-conservative makes sense. A bad move could wipe out everything and set you back years. At $20,000, with your emergency fund secured and a diversified base in place, calculated risk is no longer a threat. It is a tool. The people who treat $20,000 as the finish line instead of the starting line of real wealth building are the ones who plateau. They never make it to $100,000. They never make it to $500,000 because they optimized for protecting what they have instead of intelligently growing it. Below $20,000, adding more money each month makes a huge percentage difference. If you have $2,000 saved and you add $500, that is a 25% increase in your base. That is meaningful. But at $20,000, the math starts shifting. Your returns on invested capital begin to compete with and eventually outpace your monthly contributions. If your $20,000 is properly invested and generating 8% to 10% annually, that is $1,600 to $2,000 per year just from growth, before you add a single dollar of new savings. This is the moment where most financial advisors will tell you, stop obsessing over how much you save each month and start obsessing over how well your money is positioned. Not instead of saving more, in addition to it. But the priority shifts. Optimization of your investments becomes as important as the amount you invest. Under $20,000, most people are not thinking about tax optimization in any serious way. And honestly, below certain thresholds, the impact is minimal. But above $20,000, especially when you start moving money between accounts, harvesting gains, contributing to retirement vehicles, and generating passive income from dividends, the tax decisions you make can be worth thousands of dollars every single year. Tax loss harvesting, Roth conversions, maxing HSA contributions. These are not advanced concepts reserved for the wealthy. They are tools that become incredibly powerful right around the $20,000 mark. If you are not thinking about this yet, start now. This one is psychological as much as mathematical, and it matters more than people give it credit for. When you have $1,000 invested and it grows 10%, you gain $100. That feels like nothing. When you have $20,000 invested and it grows 10%, you gain $2,000. That is a month or more of income for many people. That is a car payment, a vacation, a meaningful number. And this feeling, this tangible proof that your money is generating real value without you doing anything, is what changes investor behavior permanently. Studies show that investors who reach the point where they can see and feel compounding tend to dramatically increase their savings rate and investment consistency going forward. $20,000 is often where that psychological turning point happens. At $5,000, putting everything into a single index fund makes total sense. Simplicity is power at small balances. But at $20,000, diversification across asset classes becomes both possible and important. Equities, fixed income, real estate exposure through REITs, possibly commodities, international exposure. The goal is not complexity for the sake of it. The goal is building a portfolio that does not collapse entirely when one sector underperforms. At $20,000, you have enough capital to build a real, resilient foundation, not just a single bet. At $1,000 in a high-yield savings account at 4.5% interest, you are making $45 per year. That is negligible. At $20,000 at the same rate, you are making $900 per year. That is not life-changing, but it is real. And when you shift that $20,000 into a properly diversified investment portfolio targeting 8% average annual returns, you are looking at $1,600 per year. Add in dividend-paying stocks with reinvestment, and that number grows faster every single year. The point is this: at $20,000, your money has enough mass to generate income you can reinvest. That reinvestment is where the acceleration begins. Most people on their way to $20,000 operate on vibes and goals. Save more, spend less, invest something. That works up to a point. But once you hit $20,000, operating without a structured financial plan is leaving real money on the table. A plan means knowing your target asset allocation and why. It means knowing your investment timeline and adjusting risk accordingly. It means understanding your tax situation and how your investment decisions interact with it. It means having clear milestones: $50,000, $100,000, $250,000, and what changes at each level. Without a plan, $20,000 tends to stay $20,000 for years. With a plan, $20,000 can become $200,000 on a timeline that most people would call impossible. This might sound strange in a finance video, but it is real. As your net worth grows, the financial behavior of the people in your circle starts to have a bigger impact on your own decisions. Friends who overspend, families that expect you to pick up the tab because you have money now, social pressure to upgrade your lifestyle just because your savings account looks better. The $20,000 mark is often when lifestyle inflation creep starts, when people begin spending not because they need to, but because they feel they have earned it. Guard against this fiercely. The fastest way to derail everything you have built is to let your expenses grow at the same rate as your savings. The goal is to keep your lifestyle stable while your net worth grows exponentially. That gap between what you earn and what you spend is where wealth is built. Protect it. Now, let us talk about the one mistake that kills most people at exactly this stage. The biggest mistake people make after hitting $20,000 is treating it like a destination instead of a launch pad. They celebrate, which is great. They should. Hitting $20,000 is real. But then they take their foot off the gas. They slow their contributions. They stop educating themselves. They assume that the hard part is over, and the rest will take care of itself. It will not take care of itself. Money at any level requires ongoing attention, ongoing optimization, and ongoing discipline. The game at $20,000 is different from the game at $5,000, and the game at $100,000 will be different from the game at $20,000. Every level has its own rules. The people who win financially are the ones who keep learning what those rules are and applying them without ego. Here is what the action plan looks like at $20,000. Number 1. Confirm your emergency fund is fully funded. 3 to 6 months of actual expenses, not guessed expenses, real, calculated expenses. Lock that money away and treat it as untouchable. Number 2. Assess every dollar above your emergency fund. Where is it sitting? Is it growing? Is it positioned for the next decade, not just the next year? Number 3. Open or maximize your tax-advantaged accounts. Your 401k if your employer matches, your Roth IRA, your HSA if you are eligible. These are not optional at $20,000. They are mandatory. Number 4. Build your target asset allocation. Write it down. Know your percentage in equities, in fixed income, in alternatives if any. Have a reason for each number. Number 5. Automate every contribution, every rebalance schedule, every recurring investment. Automation removes emotion from investing, and emotion is the #1 destroyer of long-term returns. Number 6. Set your next milestone and know what changes when you get there. $50,000 has its own rules. Learn them before you arrive. $20,000 is not just a savings milestone, it is a signal. It is your money telling you, I am ready to do more. The question is whether you are ready to let it. The people who treat $20,000 as an end point will spend years wondering why their financial life never accelerated. The people who treat it as a launch pad, who learn the new rules, build a real plan, and execute with discipline, those are the people who look back in 10 years and can barely believe how far they have come. You now know the difference. You know what changes. You know what to do. The next move is yours. If this video gave you clarity, hit that like button. It genuinely helps this channel grow and helps more people find this content. Subscribe if you are not already, because we break down these exact strategies every single week. And if you have a question about your specific situation, drop it in the comments. I read them all. I am Ron Invest. I will see you in the next one.